My background is I'm a qualified chartered accountant with KPMG. I spent a number of years in investment banking as an equity research analyst, and then I moved in 2007 to the buy side, where I worked at a company called Living Bridge, investing in public companies but within a private equity environment. I then moved along with my team and the various funds that we manage as part of an acquisition out of Living Bridge into Gresham House, where I currently work. Gresham House is an alternative specialist asset management company where we've got a number of different strategies, but in particular we have public equity and private equity. My role is I'm the managing director for the public equity business within Gresham House, which means I'm in charge of the investment team that manages a number of open-ended funds and one investment trust, largely focusing on UK smaller companies. Well, I'd say the two most challenging moments or periods during my investment career would be firstly the global financial crisis in 2008, 2009, which was a real baptism of fire in terms of being an investor, where it felt like the world and the financial system could potentially kind of all be obliterated, and taking risk in that environment, even where we could see quite compelling opportunities, really sort of required you to really hold your nerve. And then the other sort of similar period to that, although not quite as bad probably, was COVID, where again the world changed completely. We were all working from home, our working environment was different, and trying to sort of adapt the investment process, which involves a lot of meeting companies and people face to face, trying to adapt that to the new environment was really quite challenging. I guess the thing which is common about both those periods is actually the investments we made during those periods where it felt really uncertain, some of the best investments I've ever made. I describe our investment process as taking a private equity approach to investing in public companies. And what we mean by that is that we really focus on the fundamentals of the businesses. We take a high conviction approach, so we have a relatively concentrated portfolio, and where we're only investing in businesses we really believe can deliver profit growth and can become more valuable over a 3 to 5 year time horizon. We think this differentiates from our competitors because we really focus on the businesses rather than the kind of short-term share price performance, and we're really focusing our due diligence in quite a deep way on a small number of companies where we're trying to build high conviction, and where we're not really reliant on sell-side research analysts. We're relying on our own network and our own proprietary research to really build that conviction in the investment hypothesis that we build. And then we also interact very closely with those companies after we've invested. So we talk about taking a proactive, active engagement approach to companies. So we're trying to get involved in conversations about strategy, we're getting involved in board composition, and really being much more of a hands-on investor than most of our competitors would be. So our performance over the last 5 years has been strong relative to our peer group. On a 1 year view, we've been positive 9%. On a 3 year view, positive 3%, but that 3 year period was a pretty challenging period for smaller company investing, and the peer group average was a negative performance of 14%. So we made positive returns when most of our peers were not doing so. And then on a 5 year view, we've provided a return of 32% compared to the sector average, which is in low single digits. So we've managed to outperform, but we've also managed to do that and be more consistent in terms of our performance from year to year than most of the sector. So if I think about the types of market environment where our investment process and this fund should perform well, and where it might struggle to keep up, really it's down to the types of businesses that we invest in. So we're looking for resilient businesses with high margins, low financial leverage, if not net cash on the balance sheet, businesses that are growing, and businesses that have structural tailwinds to their growth or self-help levers. So if our portfolio is typically more resilient, more robust, more defensive, within the overall small cap universe, I would expect the portfolio to perform well when the market's doing less well. So if the market has a drawdown, we would expect to draw down less than the market, and that has been experienced over the life of the fund. If the market is volatile and being driven by sentiment, we would expect to be able to outperform in that environment because we're really focusing, trying to cut through the noise and the short-term sort of sentiment-driven volatility and pick winners that are going to deliver over the long term. Those businesses typically kind of are less prone to profit warnings and other things that can have a negative impact on a company in the short term. And where we will potentially lag is when we're in a bull market environment where the market flips from being driven by fundamentals to being driven by momentum, and where valuation discipline goes out the window a bit. So in a really sort of very aggressive bull market like we saw the sort of second half of 2021, it's likely that we will lag. We'll still perform strongly in absolute terms, but we would expect to sort of on a relative basis perhaps have a headwind to our performance against some of our peers that are more focused on growth and momentum than we are.